Well, welcome everybody. Thank you for attending our live event with special guest Joseph Wilbert from Broker House Lending here in Louisville. We're gonna go ahead and go through the topics and agenda. So this is our agenda for this event. We're gonna go through introductions, approval process, the mortgage products and programs that is available, home buying process, and questions and answers. And our special guest today is Joseph. He likes to be called Joe Wilbert he's a mortgage loan officer from Broker House Lending here in Louisville, Kentucky. The floor is yours, Joe.
Yeah, thank you, Joel. So appreciate everybody being here, and I appreciate the opportunity to kind of deliver a little bit of the knowledge that I've got from the mortgage side. I think the main goal today is going to be to sort of outline the home buying process, and from really pre-approval, the first part, all the way through to the closing table, just to give people, maybe particularly first-time home buyers, but really any home buyers, a better idea of what the process looks like. As Joel mentioned, I'm a mortgage loan officer with Broker House Lending here in Louisville, Kentucky. We are licensed in Kentucky, Indiana, and Florida. There's a lot of ways that you can be a loan officer. You can be a loan officer with a bank, a credit union, a direct lender, a broker. I've seen a lot of different sides of it. And, I think I can speak honestly when I say I feel like a broker maybe is the best way to go when it comes to getting a mortgage. And we'll dive into reasons why as we get into this little slideshow here. But I'm going to try and be as brief as I can, but also cover as many sort of bullet points as I can. I don't want to drag on, and we'll open it up for questions at the end. But we'll go into a little bit of slides and just kind of touch on each area of the process. And we'll start with the first part of it, which is the pre-approval process. And so really the first step, anytime you're going to buy a home, before you go looking at houses, is you want to get pre-approved. And part of that is figuring out, okay, can I get pre-approved? And if I can, how much am I pre-approved for? What type of loan product am I pre-approved for? What's the interest rate? What's the down payment requirements? All of that. And so we'll touch on each area of that. The first part is taking an application. And that's what you would do with me, with a loan officer. You take an application. For me, you can do it two different ways. You can do it over the phone, or you can do it online. I can send people a link by email. Sometimes it's easier for people to do it on their phone or to do it on their laptop or whatever. It takes probably about 10 to 15 minutes either way. Pretty quick and easy. And what I tell people is, if you're going to do it online, fill out what you can and then submit it. It's going to come directly to me. I'll review it. I'll call you when I get a chance to review everything. And then if there's any gaps or holes that we need to fill in, we'll fill those in. So that's the first part, is taking an application. For the application, the primary points that somebody probably needs to understand of what that is obviously things like full name, date of birth, social security number. What a lender is really trying to understand on a mortgage application is employment history, residential history, income, general income info. And then the second part gets into pulling a credit report, because that has to do with liabilities. Once I have the application done, the next step for me to sort of round out the pre-approval process is to pull a credit report. And, one question I get sometimes is, what's going to be on my credit report? With a credit report, really it's things like mortgage payments, car payments, credit card payments, student loan payments, things like utility bills and cell phones. Those types of things typically are not on a credit report. You can do, people are familiar with Experian Boost, where you can have those things, utility type things, added to a credit report. That typically is for somebody who maybe doesn't have a lot of credit history, and you can add that to it. But really what pulling a credit report is going to do for a mortgage loan officer like myself is give us the ability to get what they call a debt to income ratio. And essentially that is a primary sort of focal point for a mortgage underwriter and a lender, is to determine what is this person's debt to income ratio including the new proposed mortgage payment. Because one of the big questions that we're trying to answer is how much can we pre-approve you for? And the debt to income ratio is going to sort of point directly to how much we can pre-approve you for. And I'll touch on, we're going to go over the loan programs here shortly. I'll touch on debt to income ratios for each program as we get to them. But for now, we'll go to the next slide.
I want to say something, Joe, real quick. If you want to also reach Joe and do an application, you can also go to my website, joelmoretta.exprealtor.com, and there in the main page it says get pre-approved. It will show you I'm partnering with Joe. It will show you his page. You could do the application there, and he will see it and he will call you. So that's another way of also contacting Joe.
Absolutely, good
Thank
point.
you, Joe.
Perfect. Yep. Okay, so we'll dive into the products, the mortgage programs that we offer. We're strictly going to, as for today's purposes, we're going to stick to residential lending. We're not going to touch on commercial lending. We're just going to stick to residential homes. And so we'll get into really the four main mortgage products that most lenders offer. And I'll go through them. I'll point the four out, and then we'll kind of dive into each. So the first one is VA loans. Second is FHA. Okay, it stands for Federal Housing Administration. Third is conventional. And then fourth is USDA. So each one kind of carries with it different parameters and different sort of lending options in terms of what they offer. Obviously, VA loans are for active military and veterans. FHA, typically is going to be maybe a little bit lower credit score compared to a conventional loan. But quite frankly, there's benefits to an FHA loan that a conventional loan doesn't have, and vice versa. There's benefits to a conventional loan that an FHA loan doesn't have. And so you, as a loan officer, you have to look at each individual scenario and figure out from a down payment standpoint, from a credit score standpoint, look at all of it and determine what product is going to fit this person best. USDA is a great product. And one of the perks of it is it comes with no down payment. It's a little bit tricky. It's sometimes it can be threading the needle a little bit. With USDA, you have to be in a USDA eligible county. And there is a USDA list on the internet. You could Google it, that will show you which counties are eligible. And sometimes when people say, I want to go USDA, I want to, try and do this and not put a down payment down, it can be a great option. We'll get into debt to income ratios here in a minute. They're tighter on USDA, but I'll kind of backtrack a little bit and let's kind of start. We'll just go in line here. So we'll start with VA. VA, in terms of mortgage products, a VA loan, I think without a doubt is probably the best mortgage product. And there's a variety of reasons for that. One is there's no down payment requirement. You don't have to put any money down. That is different from an FHA or a conventional loan where down payment is required. So that's one perk of a VA loan, no down payment required. Secondly, there is no mortgage insurance. And some people are a little bit confused as to what that is. Some people call it PMI or MIP. Basically, it is insurance for the mortgage lender. That's probably in a nutshell the quickest and easiest way to put it. There is no mortgage insurance on a VA loan. So no down payment, no mortgage insurance. Thirdly, the interest rates are the best. There's no other product that has as good of rates as a VA loan. And I think when you look at the VA loan in its entirety, it makes sense because essentially what the government, it's government backed and it's VA, it's Veteran Administration backed, is saying is we want to give these veterans and these active military members the best deal that we can, and they do it with VA. And so I don't want to go too deep into everything with each one. I want to kind of give a brief overview of each. That's kind of a brief overview of VA. FHA, we'll touch on a couple things in terms of down payment requirements. So down payment requirement with an FHA loan is a minimum 3.5%. You got to put a minimum 3.5% of the purchase price down. That's the requirement on FHA. Credit score wise, the rule of thumb on an FHA loan is that as a mortgage broker, I've got probably 25 wholesale lenders that we can take deals to, that we are affiliated and partnered with. Not all of those 25 go down to, let's say, 580 credit score, but most of them do. So on the FHA side, I would say that from a credit score standpoint, you can go down to 580 and still put 3.5% down. I've got lenders on the wholesale side who say, hey, if it's the right fit and the credit report checks out, even if they've got a 520, we may still be able to do an FHA deal. The caveat there is that instead of putting 3.5% down, you're going to put 10% down. That's going to be the requirement below 580. So the lower you go, the higher the interest rate is, and the more down payment is going to be required. So that's where credit score comes into play, because obviously the higher the credit score, the better the interest rate, the lower the mortgage payment you're going to have. I'll backtrack real quick when it comes to VA loans and credit scores. Typically it's a 580 cutoff with my lenders. And obviously the better the credit score, what I tell people is you're going to get a much better deal if we can get your credit score over 620 on the VA side. It's going to be in your best interest to try and do that. I can still get a deal done with a veteran who's got, let's say, a 582, but it's going to be a little bit more tricky. They do what they call a manual underwrite, which I'm not going to get into now. But theoretically, we can go down to 580 on the VA side. So 580 VA, 580 FHA, even lower on the FHA side, maybe down to 520 if you're willing to put more money down. FHA is a great product. The one thing that I'll say about, and we'll touch on conventional here in a second, the major difference between FHA and conventional is the mortgage insurance, or PMI. On an FHA loan, if you put less than 10% down on the down payment, the mortgage insurance payment never goes away. It will be there forever. On the conventional side, which I'll touch on more here in a second, once you hit 20% equity in the home, the mortgage insurance or the PMI goes away forever. And so on the conventional side, we'll jump into it now. For a first-time home buyer using a conventional loan, you can put as little as 3% down. 3% of the purchase price can be put down. On the conventional side, typically you can go down to about 640 credit score. Below that, it's going to be difficult. Typically, anything below 640, I'll take that person using an FHA loan. It's going to be a better deal for them to go FHA, just from a interest rate standpoint. Conventional 640 and above, first time home buyer, 3% minimum down payment. For a second time or you're buying a house for the second, third, fourth time on the conventional side, 5% down payment requirement minimum. If you put 20% down on a home purchase with a conventional loan, you eliminate the mortgage insurance right off the bat. And so a lot of people do that. Some people think, they have a misconception that I've got to have 20% to put down in order to buy a home. That is not the case. You can come with a conventional loan with as little as 3% for a first-time home buyer, 5% for somebody who's not first-timer, but you don't have to put 20% down. The 20% eliminates the mortgage insurance right off the bat. And again, the more you put down on a conventional loan up to 20%, the less the mortgage insurance payment is going to be. So somebody who puts 15% down is going to have less of a mortgage insurance payment as somebody who puts, let's say, 10% down or 5% down. They're all great products. And again, a big part of my job is to take an application, pull a credit report, and figure out where does this person best fit from a credit score standpoint, from the money that they've got, from the money that they're able to put down. That's all part of it. We'll touch on USDA briefly. I've already touched on it a little bit. No down payment requirement. The rates are great. They're comparable to conventional loans, sometimes even better, depending on the credit score. The debt to income ratios is something that I'll touch on. I'll start with USDA and then I'll backtrack. And that's kind of where we'll end or round out the mortgage products part of it. With USDA, they've got the lowest debt to income requirement, meaning they've got the tightest restrictions. On a USDA loan, you can't go above 41% on the back end debt to income ratio. And what I mean by back end is When I pull a credit report and all of the liabilities come through, essentially what a mortgage lender is looking at is they're looking at the monthly payments. They're not looking at the balance of a credit card or a car loan. They're looking at the monthly payments. And so what happens is you take all of the monthly payments that pull through on a credit report, car payment, student loans, credit cards, collection accounts, whatever it may be. Maybe they've got a home they already own with a mortgage. And essentially what you're doing is you're dividing those monthly payments by the gross income of the person. So it's not the net income, it's the gross income. And essentially that is giving you a percentage. When you add up all those debts, including the proposed mortgage, the new proposed mortgage that the person is going to pay, that's the first half of the equation. Second half of the equation is the gross income. And that's going to give you your percentage of debt to income, your debt to income ratio. When it comes to a USDA loan, they've got the tightest. They cap it at 41%. On a conventional loan, it's capped typically below 50%. The debt to income ratio on a conventional loan has to be below 50%. In many cases, when it comes to conventional loans, you have to keep it below 45%. And so that sometimes is a reason why someone may have a fantastic credit score and they may have enough money to put down. They might have 20% to put down. But if the debt to income ratio, let's say, is 50% or 52%, because they want to buy a higher priced home, then typically we've got to go to the FHA side. The reason why is because FHA caps you at 56%. So you're capped at, technically, it's actually 56.99% on the FHA side. And so that's a major difference between FHA and conventional, is that you got much more leeway on the FHA side from a debt to income standpoint. And a lot of times that may be a reason why we take somebody the FHA route, because it gives us more leeway. On the VA side, it's interesting. The other three have caps in terms of debt to income ratio. FHA, conventional, USDA, they all have caps. On the VA side, there is no set cap. And so what I have to do, and this is getting a little bit technical, I have to take a loan application after I've pulled credit, and I've got to put a proposed property and a proposed price and down payment and all the numbers that we think kind of where we're going to land. And I have to run the loan in what is called the automated underwriting system, the AUS, for a VA loan. That is going to sort of allow me to play with the numbers. And essentially what I'm looking for when I run it in this computer system, I'm looking for an upfront approval. And sometimes people come to me on the VA side and say, okay, how much can I go with? How high can I go? Can I buy a $400,000 house? Can I buy a $500,000 house? And the answer to the question is, I need to run it in the system and let the system tell us what it's going to give us. And essentially, it is a trial and error for me to take scenarios and I plug it into the AUS, the automated underwriting system. And if I get the approval, then we know we're good. Let's say I put it in at $350,000 with no down payment, and I get the approval, we know we're good. So maybe I'll bump it to $375, and I play with the numbers, kind of a trial and error, and maybe it gives it to me. And so I bump it to 400, and maybe 400 comes back and it says ineligible, can't do it. So now I know we're somewhere between 375 and 400 in terms of where we can land. And so that's all part of sort of the upfront process of us determining how high can we go? How high can we go? How, from a loan amount standpoint, how high can we get approved for? And so I've touched a little bit on each program. I think, hopefully it gives you guys a little bit of insight into the benefits of each, maybe the drawbacks of each, the requirements of each, from credit score, down payment, et cetera. And obviously, if we're able to talk at some point and do a deal, what I tell people is, I'm going to give you all the information I can up front. And then if you get into a scenario where you find a house you want to make an offer on, and you want to put this much down, or maybe you want to put nothing down, you always have the ability to call me or text me and say, hey, Joe, run some numbers for me. Tell me, what's the payment going to be? Because that's a big part of this. Is I may be able to pre-approve somebody for a $500,000 home, but it may be way more than they want to spend from a monthly payment standpoint. And that's what I tell people is the ceiling in terms of debt to income ratio is one aspect. The more important aspect is what is the maximum comfortability zone from a payment standpoint? What do you not want to go over? Because maybe from a debt to income standpoint, you can afford a $3,000 a month payment. But if you don't want to go over $1,400 a month, then we need to back the numbers down so I can tell you, okay, if you want a $1,400 a month maximum payment, this is where the purchase price and the loan amount needs to be. And so that's a key part of my job, is relaying that information to the borrower up front when they get pre-approved, so they know, okay, here's where it stands, here's where the payment numbers are going to land. And that's kind of it in a nutshell. I'll touch real quick on just the benefits of working with a mortgage broker. You know, as I said in the beginning, there's a lot of ways you can get a mortgage. You can go directly to a bank, you can go to a credit union, you can go to a direct lender. But on the broker side, we've got the ability to do the shopping for you. And not only do we shop for you, we're shopping on the wholesale side. So everybody knows wholesale, you're going to get a little bit better deal on the wholesale side. Our company, Broker House Lending here in Louisville, and a lot of mortgage brokers, they've got dozens of wholesale lenders that they partner with and that they're able to shop with. And so that's a major perk, because it takes that out of your hands going from bank to bank or credit union to credit union, shopping for rates, when you can come to me, a broker, and I can plug in a scenario, and within about 1 minute, I can have all of my 25 or 30 or whatever wholesale banks come back basically giving me their best offer. Here's what we currently offer as of today, rate-wise, down payment-wise, all of that. And so that's a major, major benefit of working with a mortgage broker. I think the mortgage expertise part of it is key too. And I think the personal touch that you get with a smaller broker, like a Broker House Lending in Louisville, where you're going to be able to deal with one person, one loan officer only. You're not going to be passed off. You're not a number. You don't get thrown from one department to another. You deal directly with the loan officer from start to finish. And that's a major perk, from pre-approval all the way to the closing table. Essentially, what I tell people is, my whole job is to not only get you the best deal and the best rate and the lowest payment, but also to make this process as quick and as seamless and as smooth as it can be. And so, for lack of a better term, I do try to hold people's hand through it, all the way to the closing table. And what I tell people is, we're going to get you pre-approved. We're going to tell you the steps. I'm going to give you an outline of documents I need. Everything is going to come from me. And when we get this thing to the closing table, I'm going to hand you off to the wholesale lender, and that is who you're going to make your payment to. And so we try to sort of simplify it step by step and make it clear to people, here's what you can expect from start to finish. I think we've got one more slide, Joel.
Yeah, I want to touch on some stuff real quick. You could just answer them real quick, because I know the answer. I just want the audience to hear it. So how many lenders do you work? If I am Joe Moretta, I do an application. How many lenders do you run it by approximately?
I would say it's right around, it's between 25 and 30. Yeah. Between 25 and 30. Yeah.
And I just want the audience to hear that, because that is very important. Like Joe said, when I bought my home, I went through a lot of banks, and they all give you the loan estimate. And I went to Joe, because Joe was my lender, and he beat everybody. And I'm just saying that because you're going to one bank, which I recommend to go to the banks anyway. If you bank with a local go and talk to your bank to see if they could beat it. But it's really hard. I do a lot of VA loans and a lot of FHA loans, and it's when I go through Joe, it's the other banks, they just can't beat it. It's very competitive. My other question is for you, Joe. If my debt to income ratio it's high, can I bring somebody to a co-signer to lower that the debt to income ratio and help me out and get this loan? Can that be possible?
Great question. It's a great question. I'm glad you brought it up. The answer is yes, you can. You can. So you can always have a co-applicant or a co-signer on there. Now, what's going to happen with the co-signer is You can look at them two ways. They may be an occupying co-borrower or co-signer where they're going to live in the home with you. They may be a non-occupying co-borrower. And so there's a distinction there between occupying and non-occupying. There's a little bit more of a requirement in terms of non-occupying than there is occupying, just from a lender standpoint. But I don't want to get too deep in the weeds on that. The answer to the question is, if debt to income ratio is an issue, absolutely, you can add somebody as a co-signer or a co-applicant to bring that debt to income ratio down. The point that I will make with that is that you're bringing on a co-applicant or a co-borrower or a co-signer, for another word, from an income standpoint. Because when you have two people on a mortgage together, from a credit score standpoint, a mortgage lender is always going to use the lower of the two credit scores. So what happens when I pull a credit report, everybody has three scores. There's three credit bureaus: Experian, Equifax, and TransUnion. Whatever the middle score is the one that they use. And so someone may have 750 on the high end, 720, and maybe the low end 670. You see that a lot. There's variances there. The 720, the middle score, is the one that counts. If that was my primary borrower and I had a co-applicant come along for an income standpoint, and maybe they've got a 680, a 660, and a 620, so the mid score is 660, the score that gets used from a qualifying standpoint is the 660. The lower score always gets used. And so you would not bring a co-applicant on from a credit score standpoint to help with credit. You're bringing them on strictly from an income standpoint to help with the debt to income ratio.
So that whoever you're bringing in as a co-signer, you have to make sure that, debt to income, it's a check, and also credit score is a check. Mm-hmm. You want to make sure. And then my other question, I know you're probably going to touch it up, but it's eating me inside. If I don't have the 3.5% on an FHA, or the 5% or the 20% on a conventional loan, can I wrap the down payment into the loan? Can that be possible?
It's a good question. And so I'll backtrack real quick. You mentioned 20% on the conventional. That will eliminate PMI, the mortgage insurance, but you only have to put 5% down on the conventional side. That's the minimum requirement. To answer your question, the down payment cannot be financed. It cannot be financed. Okay. Now, I will say this, and we may touch on it here in a little bit. We've got a handful of down payment assistance lenders that potentially, in a scenario where maybe somebody wants to buy a home, but they don't have the money to put down, or maybe for closing costs, and we'll touch on closing costs, that may be a scenario where a down payment assistance lender could be a viable option. But in terms of the down payment itself, and quite frankly, in terms of the closing cost, and again, we'll touch on those cannot be financed. They have to be brought to the closing table.
Okay. Yeah. Thank you very much, Joe.
Yeah. Yeah. So we'll kind of round it out this last slide with just really an overview. And really what I want to talk about here, I'll touch a little bit just kind of on, I'll try and go as quick as I can, steps from pre-approval to closing. And so we've touched on a lot of this already, but I want to kind of put it in line in terms of how the process works, so that this is what it's going to be like, and here's what I'm getting into, and here's how long it's going to take, and here is when this is going to happen. And so, as we discussed, the first part is the pre-approval, doing an application, pulling a credit report, determining debt to income ratios to get you pre-approved. And then we talk about payment numbers and what the comfortable area is and all of that. That's the first step. That usually can be done, quite frankly, within about 1 hour, sometimes quicker, doing an application, pulling a credit report, and then you and I hop on a phone call and we discuss all of it. And we discuss the payment numbers and the interest rates as of today and all of that. And we touch on it all, and then you're pre-approved. And what I do at that point is I email you a pre-approval letter. I copy your realtor on it, just kind of a general pre-approval letter. And I tell your realtor, once you have a home that you want to put an offer on, send me the property address and send me the purchase price, and I'll kind of update this pre-approval letter and I'll send it to you so you can give it to the listing agent, the seller's realtor, because they're going to ask for it. So that's a big part of the first step. I pre-approve you. I send you a pre-approval letter. The other thing that I send you there typically is a checklist, the borrower's checklist of documents that we will need for the underwriting phase. And I tell people, go ahead and gather what you can, email it to me as soon as you can. You're not going to have access to all of it, but send me what you can. And that way I can go through the documents and make sure that we're good from that standpoint. Once that is done and you've been pre-approved and I've sent you a pre-approval letter and you got a checklist, you are now free to go start shopping for homes. And that's where your realtor comes in and you talk with your realtor about homes you want to go see in person. And that's where it really starts. From there, when you find a home that you like and you're ready to make an offer, you get with your realtor and you discuss the offer you want to make, and the realtor puts the offer in for you. If it gets accepted, at that point, that is when it comes back to me. The realtor obviously is still involved throughout the process, but it comes back to me from the standpoint of, okay, now we've got an accepted contract. Now we're going to take it to my wholesale lender, the 25 or 30 that I've got. We're going to take it to the one who's offering the best deal, and we're going to lock the interest rate. And typically I will lock an interest rate usually for 30 to 45 days. On my end, typically we could be done with the underwriting process and totally approved sometimes within 20 to 25 days. But usually we'll lock it for 30 to 45 because you have other people involved. You've got sellers involved. Maybe you've got a home that you need to sell first and the deal is contingent upon you selling that home first. And so we'll lock it for 30 to 45 days. From there, whatever you have not sent me from a document standpoint, I'll ask for, and I'll say, hey, as soon as you can in the next couple of days, send me this, this, and this. We're going to go ahead and build the package. We're going to order title from the title company today. And then, typically from there, you're going to get with your realtor and figure out, okay, are we going to do an inspection of the home, which is not required on the lender side, but we encourage it because quite frankly, an inspection really acts as sort of an insurance for you as a home buyer. You're going to pay an inspector to go in there and check out the electric, the plumbing, the roof, the foundation, everything pretty much, and they write a report to you and they give it to you. It's yours. You paid for it. And essentially it is an overview of the entire home. And usually at that point, you're going to get with your realtor and you're going to determine, do we need to go back to the seller and ask for any improvements or fixes to be made? Sometimes you ask for money from the seller to fix this or improve that. That can be done too. But that really is the point where you're getting with your realtor to determine, okay, have we moved past that point? Once the inspection phase is cleared, you're going to come back to me and we're going to order the appraisal. These two things, I'll make a point. The inspection and the appraisal fee are upfront out-of-pocket fees. These are fees that you pay with a debit or credit card upfront to the inspector and then through the lender for the appraisal. Okay. Everything else from a money standpoint is going to be due at closing. Okay. But these are some upfront costs that you will pay upfront. From there, essentially what's happening is we've got title back. I've got all your documents. We've got the rate locked. The disclosures have been sent out, which I would detail a little bit more once we actually were working together. I would tell you, here's what the disclosures are, and here's what you're going to do by reviewing and e-signing these. But once we have the package together, we send it to underwriting. At the same time, usually the appraisal has been ordered. And what I tell people with underwriting is always a two-step process. You send the initial package up to be reviewed. The goal there is to get it approved with conditions. It's always going to come back approved with conditions. And typically that second round of underwriting is clearing those conditions. And those typically are finalize your home insurance, maybe get us another pay stub. Maybe we had a question about a deposit on a bank statement, or maybe we need another bank statement. Those types of things to round out the file. And that's where we come back to you and say, okay, we're about halfway through, maybe 60% of the way through. We're approved with conditions. Here's what I need from you to get this to the finish line. Within about a day, 2 days, 3 days, you give me everything I've asked for. We send it back to the underwriter for one final review. Usually takes about 1 to 2 days for them to review it. and then they clear it. And from an underwriting standpoint, we're done. From start to done with underwriting, I'd say typically you're looking at about 15 to 20 days window. The other part of it is within about that time frame of getting the underwriting approval, usually you're getting the appraisal report back. And typically you're hoping for what they call an as-is appraisal report, where it comes back with no corrections needed. And if that's the case, from there, the last part of the mortgage process, once you have the final underwriting approval, is to get what they call a closing disclosure sent out. The closing disclosure is essentially basically a summary of your loan, your interest rate, your payment numbers, all of your closing costs, the APR, all of this stuff. They're going to send this document to you to be reviewed and signed. And once you sign it, from a mortgage standpoint, you have to wait 3 business days before you can close the loan. Once that 3rd day comes, you're free to close the loan. And so that's where I get back to on my end, if everything goes smooth, which typically with my deals, they do, not always, nothing can be perfect, but usually they do. You're looking probably somewhere in the 25-day ballpark of being essentially done. And if it checks out on the seller side and they say, hey, we're ready, let's close this thing, you line up a closing and you get it to the closing table and you're a new homeowner. So that's really kind of in a nutshell, a quick overview from A to Z, pre-approval to the closing table. From a documentation standpoint, I'll touch on just the basics of what is needed. Typically is going to be 2 years of W-2s if you're a W-2 employee. If you're a W-2 borrower, you'll need the most recent 2 years of W-2s. I typically ask for 3 pay stubs, your 3 most recent pay stubs, and then I'll ask for 2 months of bank statements from whatever account is going to be used for the down payment and or the closing costs. That's really the financial bulk of it. If you're a self-employed borrower, if you own your own business, usually I'm going to ask for 2 years of tax returns. So if you're a W-2 employee, you're not self-employed, I don't necessarily need tax returns. If you're self-employed, I'll get the tax returns. But that really is going to cover the financial stuff. I'll ask for things like your driver's license or a picture ID. On a government loan, like a VA loan or an FHA or a USDA, they want a copy of your Social Security card. There will be an earnest money deposit, which basically another word for it is good faith deposit that you put down up front to your realtor. That will be something that they'll want a copy of and that I'll ask for. That really, from a document standpoint, is the bulk of it. The tax returns, if needed, W-2s, pay stubs, and bank statements are going to be the keys there up front. And then we kind of fill in the gaps depending on each scenario can be a little bit different. And we fill those gaps in as we go. I touched on upfront cost. Earnest money deposit is the good faith deposit. A lot of times it's 1% of the purchase price, but it can be less, it can be more. But ballpark, typically it'll be about 1% of the purchase price. Inspection fee, you can go with any inspector you choose. A lot of times a great realtor like Joel will give you maybe a recommendation of an inspector that he has used or that he knows and trusts. Sometimes, those fees can be a couple $100s to maybe sometimes high hundreds, just depending on who the inspector is, the size of the home, things like that. And then lastly, the upfront cost of the appraisal. And the appraisal prices usually go anywhere from about $500 to $600, give or take. They differ based on whether or not you're using a VA loan, an FHA loan, a conventional loan, or a USDA loan. But they're within that $100 range, $500 to $600. Closing cost, and this will be the last thing I touch on, just to kind of round it out in terms of a lot of people will say, what are these? What are these made of? What is a closing cost? The bulk of the closing cost, and this is separate from a down payment. So it's completely separate from a down payment. It has to be paid at closing. You can't finance it. Every now and then you're able to maybe get the seller to chip in on the closing cost. It's tough. It's very tough in this competitive real estate environment to get a seller to pay closing costs, but it's doable, it's possible. But what are they made of? The first biggest category is title fees. You have to close a home loan with a title company. They're going to charge you an attorney's fee. They're going to charge you title insurance fees. They're going to charge you recording fees. And so that's going to be a major component of closing cost is title fees. Secondly is prepayment of taxes and insurance, property taxes and homeowners insurance. And so when it comes to homeowners insurance, anytime you buy a home, a lender is going to require 12-month premium home insurance to be paid at closing. So that is considered what they call a prepaid. You got to pay your home insurance premium for the full first year up front. What they do in addition to that, most people do what they call escrow, which means when you make your mortgage payment, the taxes and the homeowner's insurance payment is part of that mortgage payment. You're making it to the mortgage company. When it comes time once a year for the taxes and the insurance to be paid, it's the responsibility of the mortgage company, the servicer of your loan, to pay it on your behalf. You've paid it with your mortgage payments. Now they've got it in an escrow account and they're the one who dole it out to the insurance company and to the county sheriff for the property taxes. So what they're going to do with escrow, they're going to, like I said before, they're going to collect 12-month prepaid premium of home insurance. For the escrow account, they're going to collect an additional 3 months of home insurance. When it comes to property taxes, how many months they collect depends on the month of the year that you close. What happens when you close a home loan, let's say you close a loan in April, you're not going to make your first mortgage payment until June. So you skip the month you close in, you skip the next month, you make the first payment in the following month. If you close in August, you're not going to make a payment till October. And so the closer you get to the due date of the property taxes, which in Kentucky, the earliest you can pay is November the 1st. The closer you get to November, the more months the mortgage company is going to collect from an escrow standpoint when it comes to taxes, because they know we're getting pretty close to that payment coming due. Now, what happens is when it comes to taxes, the seller of the home is paying the portion from January 1st through the closing date. So they pay that portion January 1st through the closing date. At closing, you pay from the closing date the day after through the end of the year. That's the way it works for a buyer. So that's second component of closing costs. We got title fees. We've got escrow set up and prepaids for insurance. Thirdly is what they call a lender's underwriting fee. And whether it be a bank, a credit union, a wholesale lender, they all charge underwriting fees. Sometimes they get rolled into the interest rate. Sometimes they just get paid at closing. Typically you have the option to do either or. You can roll it into the rate or you can just pay it at closing. Usually some are $900, $950, some are $1,100, $1,150. I would say on average, you're looking probably at about $1,000 for, they call it an administrative fee or an underwriting fee. So those three components, title, escrow, and underwriting fee, are the primary factors when it comes to closing costs. There's other little fees like verification of employment fee, a credit report fee. These are little $40, $50, $60 fees. The miscellaneous fees like that, they may add up to a couple $100, but the bulk of it is going to come from the three categories I mentioned. The rule of thumb when it comes to closing costs, because people will say, well, how much are my closing costs going to be? And up front, it's a little bit of an estimate because you don't have exact title fees yet. You have an order title. You don't have exact insurance or tax fees yet. You haven't gotten those yet. Title company hasn't gotten them yet. The rule of thumb is that typically it's roughly about 2% of the purchase price. And so if somebody buys a home for $200,000, you can bet that the total closing costs are going to be somewhere around $6,000, around 3% of the purchase price. As you get a little bit higher, it may be more, it may be a little bit closer to 2.5% to 3%, somewhere in that ballpark. But I think 3% is a good rule of thumb. So I'm going to sort of leave it with that. I know I've gone over what I wanted to, but I think hopefully I've given you guys just a good picture of what the process looks like, what the components to different types of mortgage products and loans look like. And at this point, I think, I'll be happy to answer anybody's questions that they have.
Joe, I have a few questions that did come in. The first one is, How much are rates at the moment?
Yeah, it's a great question. So, for people that have kind of been paying attention recently, you may have seen where rates are starting to tick up. 2020 and 2021 really saw the lowest interest rate levels ever. With a lot of loan products with good credit scores, the rates dipped into the 2%, mid 2%, high 2% range. I don't know that we're going to see the 2% anymore. As of right now, with a good credit score, and what happens is, and I'll kind of preface it with, each loan product that I mentioned, VA, FHA, conventional, USDA, the interest rates differ a little bit with each one. It's not a drastic difference, but it's a little bit different. And as I said, VA typically have the lowest. Right now, with a good credit score, and when I say good, when it comes to credit scores, 680 is a good credit score. 700 is a very good credit score. 740 and above is top tier when it comes to mortgages and pricing. And so if you've got a 740 or above, a great credit score, and you're going to do a loan with a VA loan, you're going to buy a home with a VA loan, you're probably looking at a par interest rate currently somewhere around maybe 3.3 to 3.5% on a 30-year fixed rate. We can do different terms. You can do a 25-year, you can do a 20-year, you can do a 15-year. There's really not much difference in the rates between the 30, the 25, and the 20. Where you see a difference is going down to a 15. You're going to get a lower rate on a 15-year. The give and take of it is, on the 15-year, you've cut your term in half. And so even though the rate is lower, the payment is going to be higher because that term has been cut in half. But on the VA side, you're looking kind of in that low to mid 3% range. On the conventional side, you're looking in that high 3% to around 4% range on a 30-year fixed rate currently. FHA, you're right in that kind of mid to high 3% range on the FHA side, and USDA is very similar to FHA. I would say 3.5% is a good ballpark with a really good credit score. As the credit score drops, the interest rate goes up. And so that's kind of in a nutshell where we stand. But with good credit scores, you're anywhere from low 3% to high 3% currently.
So what I'm hearing is like if you're trying to buy a home, basically you have to hurry up and get it done. You still could buy it obviously at the end of the year or in 2023, but the rates, like you said, Joe, at 2.25, 2.75, 3, low threes. It's probably, those days are probably over because I know that I heard there's gonna be like 2 more rate jumps probably at the end of the year. At least one is still pending, and we already had 2 already. So if you're trying to buy a home, my advice, and I'm pretty sure Joe will advise to hurry up and do it now as soon as possible before the rates jump up again.
But I totally agree. Totally agree. It's a great point because I think what we're going to see probably for the next 18 to 24, maybe 30 months is a steady increase in interest rates. It's already happened back in January and it's continuing to happen where interest rates climb steadily. What happens as a mortgage broker is that I come into the office every day and I've got 20 emails waiting for me. It's an email from each of our lenders and they're telling me where their rates are currently. Mortgage rates act similar to the stock market. They go up and they go down and they can fluctuate throughout the day. I'll get emails all day long saying, okay, we got a price improvement or we got a price deterioration. Rates are getting worse. I'm seeing a lot of deteriorations recently. And so I agree wholeheartedly with the notion of if you're on the fence and you're thinking about maybe doing something soon, from an interest rate standpoint, the sooner the better, because I think from here for the foreseeable future, probably well into 2023, going 18, 24 months out, we're probably going to see rates continuing to tick up. So now would be the time to still jump on these low rates. Rates in the 3%, 3.5%, even 4% range, relatively speaking, still a very good rate. It's not a 2.5%, but again, I don't know that we're ever going to see twos again. We could, but I think it's way down the line. Yeah.
Yeah, those are kind of like the rates that we were having before the pandemic started. It was like we're going back to the normality in the mortgage rate kind of like era.
That's 100% right. Things are starting to normalize, and people as human beings, we get sort of accustomed to what currently is happening. I think as of right now, people are accustomed to uh, rates in the twos and the low threes. And I
Yeah.
think it's going to take a little bit of time for people to realize that was a little bit of an anomaly, and it was there for maybe a year and a half, 2 years. We don't know if we're ever going to see it again, but a rate at 4%, relatively speaking, still a pretty good rate. You go back to 1980 and around that time, you had rates at 11, 12, 15, 17% mortgage rates. That was a different time. But people from that generation, they look at a rate of 4 or 5% and they think that's incredible. When I bought my first house back in 1978 or whatever they say, I paid 14%, and so 4% or 5%, relatively speaking, still a good rate.
14% is gonna knock me off my chair.
That's right.
But yeah, I mean, I have a few other questions, but you already answered these in the past slides. I mean, about the low credit scores, you already touched on that. Down payment assistance, you already touched on that. Unless you want to say anything else on that. Somebody was asking, do you offer down payment assistance?
Yeah, it's a good question. So with the credit scores, the low credit scores, I think I touched on that in terms of in a certain scenario on the FHA side, we might be able to go down to 520. On the VA side, 580. On the conventional side, 640. On the USDA side, I may not have said USDA. USDA cuts you off at about 640. Can't be below 640. When it comes to down payment assistance, we've got a couple wholesale lenders who offer some good programs. One is on an FHA loan, they will cover up to 6% of the purchase price. And so what that includes is with FHA, you're required to put 3.5% down. What they will do is they'll cover up to 6%. So they'll cover the 3.5% down payment. And then in addition to that, they will cover a 2.5% of the closing costs. And so they're covering the bulk of certainly all of the down payment and a bulk of the closing costs. It's a pretty good deal. It really is. I've dealt with different down payment assistance lenders. This is the best product that I've seen. It's called Rosebud with one of my wholesale lenders. It would be the product that I would steer someone toward if they were in that market of needing help with down payment or closing costs. There's always, and what I tell people is there's always a give and take. When it comes to down payment assistance, when a lender is saying, okay, we're going to cover your down payment and or your closing, the give and take of it is they're giving you this money. You're not pulling it out of your pocket and bringing it to the closing table. They are. The give and take is the interest rate is going to be higher than it normally would if you had your own money to bring to the table. And so it may be a difference of 1 percentage point, where if you had your own money, maybe you get a rate of 3.5%. If you're going to use the lender's money for the down payment program, the rate might be 4.5%. So you're going to pay for it from an interest standpoint. But in a scenario where someone really wants to get into a home and they may not have the money saved at that point, it's a great option. It potentially is a great option. What I will tell you with that program in particular, these programs with down payment assistance, they do have credit cutoffs. With this particular program, the minimum credit score is 660. You have to have a mid score of 660 or above. But if you do, then you qualify. And if you're somebody who is looking to buy and you don't have the money saved, could be a great option. You always have the option to get into a home if that's the near-term goal, and then maybe wait for rates. Maybe it takes a year, 2 years, 5 years. But if you're still in that home and you're still in that loan, when rates drop, you have the opportunity to what they call refinance, to lower your interest rate. And so sometimes it makes sense to take what you can get to get into a home so that you're not throwing that money toward rent. You're throwing it into your home and building equity in that home. And then when the rates come back down, you go to your lender, like me or any lender, and say, hey, looks like rates have gone down. I want to refinance to lower my rate and lower my payment.
Yes. And it's also the market appreciates. So you're also, you know, your equity is also growing through appreciation. So
Great point. Great point.
so Joe, just to wrap this up, I mean, there's one more question. What areas do you service? Like what in what states are you licensed to lend?
Yeah. So as a mortgage loan officer, you have to be licensed in individual states to be able to do business there. For our company, we are licensed in the state of Kentucky. And when you're licensed in a state, you're licensed in every city and county in that state. You can do business in the entire state. So we're licensed in 3 states currently. We're licensed in Kentucky, we're licensed in Indiana, and we're licensed in Florida. We may be expanding soon into Tennessee. There's a couple others, maybe out on the East Coast, maybe a Texas in the future. But the 3 that we primarily do our business in right now are Kentucky, Indiana, and Florida. And those are the 3 that we're licensed in currently.
Yes, definitely. And I would like to close with this. I mean, I know Joe for a while now, and you know, I have clients that go to many different lenders. Most of my clients, you know, they end up with Joe, obviously, because he's a mortgage broker, and you know, it's really hard to beat them. You know, with Joe, if somebody gets approved with Joe, I say, and it's, you know, it's gonna be high, but it's about 99% closing rate. Like I know that we're gonna close on if Joe approves this person, and the way I operate, you know, I do everything for my clients, and Joe is the same way. Joe will, you know, he would, you know, do everything that he can to make sure that you get the best rate possible, and to make sure that underwriting is going smooth. And also he also works with title companies, and he helps out with that, you know, with the title process too. So, and, you know, and Joe could get you qualified within, I seen Joe most of the time, his time to get you qualified under an hour. You do an application, he's gonna, you know, he's gonna answer within an hour. And within an hour, 30 minutes to an hour, I could have an approval letter in my hand, and I could write an offer and get it accepted. So you know, broker house lending, it's they're superb in what they do. And Joe, it's one of the best. You know, I if I have to recommend one person here in Kentucky or in Florida, or what was the other state, Joe, that you work in?
Yeah, sure.
Indiana, it's gonna be Joe. It hands down.
Well, I really appreciate those kind words. I really do. And I think you and I are similar, Joel, in the fact that we're service first. It's all about the client, and it's all about a good experience. And what Joel said about me, it's not me blowing smoke, could be totally reciprocated to him in terms of how he takes care of his clients. One thing that we're able to do together, really, which is sort of the way that we got introduced a couple of years ago, was through this Homes for Heroes program. Joel obviously is a veteran himself. My company here in Louisville, Kentucky is veteran owned, and that's how we got involved with it. But that was sort of the foot in the door for Joel and I to start working together. And really, I can't tell you enough how happy I am that we got that opportunity to be introduced, because
Definitely, yeah.
it has created a great relationship. And, you know, being a veteran owned company, Joel being a veteran, we cater to everybody. We cater to veteran, non-veteran, it doesn't matter. Our goal is we want to have a great experience for our buyers. That's the whole point of all of this, is to do it quick and to do it seamless. But Joel may want to touch on maybe in this one, maybe in another one, just sort of the Homes for Heroes program that we're involved with,
definitely,
and all of the benefits of that too. Yeah,
definitely. Thank you very much, Joe. So this, you know, this is our contact information. You know, I'm brokered by EXP Realty, and I service, you know, the Hardin County, the Jefferson County, you know, anything in this area I service. And Joe, you know, he could, you know, he does loans all over Kentucky, Florida, and Indiana. So if you need, you know, to reach out to us, you know, you could call Joe directly. You know, you could send him an email. You know, you could find me on YouTube. You know, this video will be on YouTube in a couple of days. I'm on Instagram, Facebook. I'm also on LinkedIn and Twitter. So, I'm gonna go to the next slide. You want to say anything on this slide, Joe?
No, I think that wraps it up. You can go to the next one if you want to.
And I want to first, and I want to thank Joe for giving his time to us. He had a really busy day today, and I also want to thank everybody that's attending. It is, I we kind of put it at 6 o'clock because I know everybody has to go, come from work, get situated, reset, and then no, I really want to I appreciate everybody. Thank you very much for attending, and hopefully we could assist you in the future. And if you have any questions, just let us know. So that
Yeah,
will wrap it up.
great
So
points. Yeah, I'll wrap it up with this. First off, I appreciate the opportunity because I love getting in front of potential buyers. At the end of the day, what we're trying to do is make this experience as easy as it can be. When you're buying a home, it is the biggest financial expenditure of your life. It always is going to be. A home purchase is huge, particularly for a first-time home buyer, but for any home buyer, you want somebody that is going to sort of cater to you and walk you through it, and on both sides of it, the mortgage side and the realtor side. And I think at the end of the day, that's what Joel and I realize, is that making things as easy and as smooth and as streamlined as they can be is the whole point of all of it. And so that's what we do. Would love to help any of you who ever have questions on mortgages, or Joel on the real estate side. But really appreciate the opportunity to be here. Joel, thank you, sir.
definitely, thank you very much, and thank you everybody, and we'll see you soon.